In this session on CFA Level 1, we will explore the yield curve and how to decode both YTM and current economic trends.
Hey everyone, and welcome to another Explainer. Today, we are diving into an absolutely crucial topic from the CFA Level 1 syllabus. Whether you're actively studying for the exam or just trying to figure out the secret language of global bond markets, we're going to decode the yield curve together and unmask what yield to maturity, or YTM, really means.
Okay, let's take a quick look at our roadmap. We'll start by decoding the yield curve, then sit in on a coach's masterclass, explore AI and fixed income, run through some CFA Level 1 practice questions, and wrap up with pro tips for aspirants.
All right, let's jump right into Part 1, decoding the yield curve and its basic math.
So, what actually is a yield curve? Well, simply put, it's a graph. It shows us the relationship between the yield, specifically the yield to maturity, or YTM, on a bunch of bonds and their time to maturity. We typically build this using risk-free government bonds as our baseline, but the concept really applies globally. It's essentially a snapshot of what the market thinks future interest rates are going to do.
Now, I know finance math can seem a bit intimidating, but the formula here is surprisingly elegant. It's just y equals f of t. That's literally it. The y stands for yield, or YTM, and the t stands for time to maturity. So the yield is really just a function of time. And when you graph that function, you get three classic shapes. First, you've got the normal curve, stepping upward, which tells us, hey, we're looking at healthy economic growth. Then there's the inverted curve, stepping downward. That's a massive red flag. It usually signals a looming recession. And finally, the flat curve, which points to market uncertainty, kind of like the economy is holding its breath. Moving on to Section 2, the Coach's Masterclass, a Socratic dialogue.
Picture an elite finance boot camp. The coach looks at the room and asks, "All right, team, today we connect the yield curve and YTM. Who can tell me what YTM actually is?" It's the ultimate foundational question, right? Because if you don't know what YTM is, the yield curve is just, well, a meaningless line on a chart.
An analyst pipes up and nails it, saying, "Sir, YTM is the total return we earn if we hold a bond till maturity." Exactly right. And if you take that specific YTM for bonds across a whole bunch of different maturity dates and plot them together, boom. That collection of individual YTMs is exactly what creates the yield curve.
Now, what's really interesting here is why long-term bonds almost always demand higher yields. The coach breaks it down into three main reasons. First, you've got inflation risk quietly eating away at your returns. Second, there's interest rate uncertainty over the long haul. And third, liquidity preference. Investors simply want a premium if they're going to lock their cash away for 10 or 20 years.
To wrap up the masterclass, the coach draws a really critical distinction between shifts and signals. See, the curve actively shifts due to monetary policy. When central banks, like the Reserve Bank of India, change rates, they physically shift that curve up or down. But the shape of the curve, that is a passive signal. It signals underlying economic expectations to the market, like how that inverted shape is warning us about an economic slowdown. Knowing the difference between a shift and a signal is absolutely crucial for reading financial news. All right, let's step into the future with Section 3, AI and fixed income and modern analysis. It is seriously amazing how AI agents like Microsoft Copilot are transforming into real-time financial labs. Just look at these 5 key functions. It handles yield curve visualization instantly. It automates your YTM calculations, completely eliminating manual trial and error. It runs scenario analysis, digs up portfolio insights for risk and return, and honestly, it acts as a phenomenal learning and revision tool on the fly. Let's actually walk through an automated scenario analysis. Step 1, you just type in, "What if interest rates rise by 2%? Step 2, the AI instantly calculates that complex yield curve shift. Step 3, you see the exact impact on your bond prices right there. What used to take analysts hours of tedious spreadsheet tweaking now gives you actionable insights in literally seconds. It's a real game changer.
Okay, time to test what we've learned. Section 4, CFA Level 1 Practice Exam Drill.
Let's do a rapid-fire drill. Question 1. An upward-sloping yield curve indicates what? Is it A, recession, B, economic growth, or C, a market crash? Think back to our 3 curve shapes. If you went with B, economic growth, you absolutely nailed it. Remember, when long-term yields run higher than short-term ones, the market is betting on a healthy, growing economy. All right, keeping that momentum going, here's question 2. If short-term yields actually exceed long-term yields, the curve is A, normal, B, flat, or C,
Inverted.
The answer is C, inverted. And as we talked about earlier, this is that huge red flag. An inverted curve is a classic signal that the market is bracing for a recession.
Okay, final question to really cement the foundation of this whole explainer. Question 3. Each point on the yield curve represents A. Coupon rate, B. YTM, or C. Face value.
And of course, the answer is B, YTM, yield to maturity. The yield curve is literally just a collection of these individual YTMs plotted across time. Great job if you got all 3 right.
Let's bring it home with Section 5, Pro Tips for Aspirants, the Playbook.
Listen, when you're prepping for the exam, your smart strategy has to be visualizing these curve shapes and connecting them directly to macroeconomics. Make that mental link between shape and economy. On the flip side, avoid the classic rookie trap of confusing a bond's coupon rate with its YTM. They are definitely not the same thing. And whatever you do, don't ignore the economic interpretation. The math is just half the battle. The economic meaning is what they're actually going to test you on.
I want to leave you with this one really powerful thought. If YTM tells you the return of a single bond, the yield curve tells you the story of the entire economy. It is the ultimate pulse of the market. So the next time you see a yield curve in the financial news, ask yourself, what story is it telling us about tomorrow? Thanks for hanging out with me for this explainer, and keep studying hard.